Hey everyone, there's no doubt that life insurance is one of the most important part of our financial planning, especially when we have dependents like our parents, wife and kids. Now a lot of people make the mistake of mixing insurance and investment. And I always say that you should never mix insurance and investment and opt for a term plan. In fact, I've already done a video in the past explaining the type of insurance and why term plans are the best. The benefit of opting for a term plan is that you can get a high life coverage of 1 crore and beyond at a very nominal cost. But let me be honest, it's not easy to select the right term plan. So in this video, I would help you understand what is the right amount of term plan you should take. Then I would explain the key parameters to look for while selecting the term plan. Finally, there's a new option of zero cost term insurance that is attracting a lot of eyeballs. I'll share my insight on whether the zero cost term plan is good or not. So if you are looking for a term plan, then this video can be of great help. Stay tuned till the end. Alright, let's get started. The first question that comes to our mind before taking a term plan is, what is the right amount of term plan you should take? Is 1 crore rupees enough? Now this is a very important decision because we don't buy term plans multiple times. In many cases, we take it only once in our life. And the term plan coverage we decide today gets logged in. So it's very important to decide the ideal coverage of a term plan. Well, if you think about it, 1 crore rupees might look like a huge corpus today, but what if your family need this money 20 years down the line? In 20 years, the value of 1 crore would be only 37 lakh. In fact, there's also a thumb rule that says you can take a term plan 10 times your annual income. For instance, if your salary is 12 lakh, then 12 into 10, which is 1.2 crore. The catch is that it is not an ideal way to calculate term plan coverage. Let me give you an example. Let's say Karan is 27-year-old and earns 12 lakh per year. He's single and doesn't have a lot of expenses. His parents are dependent and have expense of 15,000 a month. You can see on the screen that he does not have a lot of expense. But the catch is that Karan is planning to get married by next year, and then of course he would want to buy a house, car and plan kids. Basically, after marriage his expenses will shoot up significantly. And in the next few years, he would eventually end up having an expense of 1.25 lakh per month at let's say age of 32. That's an expense of 15 lakh per year. You see the point? The thumb rule for term plan coverage did not consider the change in Karan's lifestyle. So if Karan would have taken a term plan of 1.2 crore rupees, how long can his family sustain with this money? Hardly a few years. Hence, it's very important to have a good projection of your expenses for the next few years that would also include your inflation to ensure that in case of an unfortunate event, even if your family keeps that money in FD, they would at least have the corpus to take care of their daily expenses. So there's an interesting calculator that you can find on Ditto platform that can actually help you calculate the ideal term coverage. For instance, you got to enter the age. Let's assume you are 30 years old. And second thing is you got to enter the protection duration. So let's assume you keep it till 60. And then you have to enter the monthly expense. Let's assume your monthly expense of 50,000 rupee and final is outstanding loan. Let's keep it 0 for now. If you click on calculate, it would show you the recommended cover is 2.1 crore. Here your expected expense are as follows. 50,000 a month in 2023 would eventually become 2.27 lakh a month by 2053, basically considering 5% inflation. So if your dependent receive 2.1 crore corpus, they can set aside this money in bank account and use this interest and principal to cover their expense, and this can last till 60 years of life. Again, here we have not considered outstanding loan. So if you have let's say a loan of 20 lakh and you put that amount and click on calculate, it would consider 2.3 crores of coverage. Basically, it has also considered your loan amount because if anything happens, you have to pay the loan as well. So that's a very interesting one. You can just play around with the age and duration and of course your monthly expense and just click on calculate and it will give you the ideal cover. By the way, Ditto is a new age insurance provider that is solving the problem of insurance mis-selling in India. They offer honest and spam-free advice. Ditto team is also backed by Zerodha. You can set up a free 30-minute call with their advisor that can guide you properly in selecting the right term plan. Now let us look at the key parameter that you must keep in mind before shortlisting the right term plan. Today there are many insurance companies in the market. The question is, how do you shortlist an insurance company? So first parameter is check for claim settlement ratio. So let's say if there are 100 claims, a claim settlement ratio of 98% means out of 100 claims, 98 claims are settled by the company. Needless to say, higher this ratio, better it is. You can get this data on IRDAI website if you simply Google it. Then second important parameter is check the volume of complaint. See, ideally you want to select a term plan with lower complaint. So out of 1000 claims registered, if the total complaints are more than 20, then it is a concern. Again, you can Google and get this information. Then third parameter is check for amount settlement ratio. Some insurers pay out the smaller claims while declining to pay out the few higher value claim in a bid to improve the claim settlement ratio. So you will need to look at the total amount settled as percentage of total value claimed. A number above 90% should be good enough. You can also read all these details on Ditto platform where they have nicely divided factors to shortlist a life insurance company. Then they have some must-have policy specific features like critical illness benefit, then accidental death benefit, where some policies offer you the option of adding extra protection for accidental death. You also have an option of increasing cover benefit, while some policies automatically increase your cover by a certain amount to always provide you with the necessary protection as you go older. This can be a useful feature to tackle the inflation related problem. Now recently there is a new category of term insurance being introduced that's called zero cost term insurance. So let's try to understand what exactly is zero cost term insurance. While term plan is great, a lot of people have a problem with the term plan. The problem is it does not pay anything in case the policy matures and you survive the entire period. Although the real purpose of term plan is only to provide financial protection to the dependent in case of death of the bread earner. And that too, they give a very high coverage at a very nominal premium. But human psychology is that we don't like to think about extreme situation in life. So the first thought that comes to our mind is, if I survive the policy tenure, I would lose the premium paid for the term plan. And hence to cater to this scenario, insurance companies have come up with a unique product called zero cost term insurance. Basically, zero cost term insurance returns your premium at some fixed date. It means you could buy a term insurance plan, pay the usual premium for a fixed number of years, and then forgo the policy and have all your premiums returned to you. It means you get to avail the benefit of a term plan without paying anything. Well, it might sound very interesting, but the question here is, why would insurance companies offer you a term plan at zero cost? How would they make money? And the fact that they handle thousands of claims each year, totaling hundreds of crores. So basically, there are certain terms and conditions that you must be aware of. First of all, if you want to offer a zero cost term plan, majority of these products have a minimum of 35 to 40 years of policy duration. It means if you are say 35-year-old, you would have to take the term plan till 70-75 years. Now you might ask, Sahil, what is wrong with that? The issue is that generally we need a term plan till 60-65 years of age, because after that age, you would have a decent retirement corpus, your kids would have already settled, and your wife would not have to depend upon the term plan money. So if you take a term plan beyond the age of 60-65, say 70-75, you would end up paying a very high premium, which is not really needed. So the first catch is that your annual premium would increase in case of zero cost term plan. But then you might say, we would anyways get the money back, isn't it? Yes, you would. But the real value of money that you would receive would be much lower. For instance, let's say you opted for a zero cost term plan that has a premium of 10,000 rupees per year. And let's say the insurer pays back the money after 25 years. Now the real value of that 10,000 rupee after 25 years is just 2,950 rupee, assuming 5% inflation. Likewise, second year premium of 10,000 would have a value of 3,100 and so on. So yes, you would get the same money back, but the real value of that money is much lower. In fact, zero cost term plan would actually work in favor of insurance companies because you can forego the policy to claim the premium only during a specific time period mentioned by the insurer. For example, let's say you opted for a zero cost term plan that says to get the premium back, you can only forego the policy when you turn 55 years old. So foregoing your zero cost term insurance to get the premium back is not that simple. There are certain terms and conditions. The next catch is that you would end up exiting the zero cost term plan during an early life stage to claim the money back. But majority of claims generally comes during the later stage of life. So insurance companies can get away with paying a much smaller amount of premium as compared to the actual term plan cover. Having said this, the zero cost term plan can be really helpful if you are young. I hope you got a fair idea about zero cost term insurance. In case you are still confused about the right term plan, You can compare multiple term plans on Ditto platform. Just select the option you want to compare and you can get a detailed comparison across various parameters that include claim settlement ratio, amount settlement ratio, complaint per 1000 claims settled, zero cost option, and many other features. At the end, you can also get the conclusion suggesting which is a better option. If you want to explore Ditto platform, I provided the link in the description and pinned comment. I hope this video would give you a fair understanding about some important concept related to how to select the right term plan and what is zero cost term plan. If you find this video useful, do share it with your friends. I'll see you next video. Till then, take care.